Hi, I'm Pattu from freefincal. Yes, it's possible to create a risk-free debt mutual fund. Well, practically risk-free debt mutual fund. There will always be some risk, but those risks are uh, fairly uncommon, and on a typical for a typical investment journey, they are very unlikely to happen. So, uh, there's something known as interval funds or interval mutual funds or interval income funds, as some people like to call it, and so on. I've written about it, and using this and using a portfolio of gilts, that is government bonds, it's possible to create a virtually or practically risk-free debt mutual fund. So the problem today is that uh, within one single mutual fund category there is a lot of inhomogeneity. There are so many types of funds within a single mutual fund. I mean, uh, the problem with SEBI seems to be, whether it is with respect to investment advisors or mutual funds, they like to paint everything or everybody with the same brush. That is the main problems. You may have noticed this talk about investment advisor regulations and the changes they have proposed, and how I have opposed it, and other people have in the advisor community have opposed it, and so on. The main problem is that SEBI is treating all investment advisors as the same entity. Within that category of investment advisors, there are investment advisors who invest, I mean, who provide stock tips, whose main service will be stock oriented. Some of them will provide a proper stock service for long-term investing. Some will provide stock tips. Some will provide only financial planning based on mutual funds without any stock component. Some will mix them. Everybody is called an investment advisor, and in order to curb, mis-selling and fraud by those investment advisors who are providing stock tips and kind of shady dealings, they want to curb everybody, including people in my list. You can see the menu in the menu item here, the fee only financial advisors who are only charging a flat fee, and primary goal is only financial planning. Same thing happens when you go to the liquid fund category. In the liquid fund category, you will find debt funds holding only cash. You will find debt funds holding, most of it will be government bonds, and you will see debt funds taking on risk with they will take on high yielding corporate bonds but with a low credit rating. So it is very difficult for a novice investor. They will think, oh, this liquid fund is giving more return than the one with cash or government bonds. They will not know that it is because of the credit risk, and they will put their money in and burn their fingers. So the painting everything with the same brush is a big problem, and we must have liquid funds that will only hold government bonds, liquid funds that will have only let's say PSU bonds or bank certificate of deposits, liquid funds which will take on credit risk. That kind of a demarcation must be there. There should be subcategories in order to help investors take more informed judgment, and that's missing. And coming back to the subject of this video, see, an interval fund is a combination of an open-ended fund and a closed-ended fund. In an open-ended fund, you can buy and sell. That is, you can buy units from the AMC by giving them money, and you can sell units back to the AMC and getting back money at the market value at all times. That is, for all trading days or all business days, you can buy and sell units with the AMC. That's called an open-ended fund. In a closed-ended fund, you can buy units only during the NFO period, the 2-week NFO period, and then only at the end of the closed-ended tenure. That is, whenever they say after 1 year, 2 year, 3 year, 5 years, whatever it is, at the end of the tenure will you be able to give back the units to the AMC and get back the money at that current market value. That's called a closed-ended mutual fund. Of course, in principle, the closed-ended fund will be listed in the stock market. It will be available for sale and purchase. If somebody is selling, someone can buy via a demat account and so on. In principle, but that's practically, that liquidity is pretty much zero. So those are the two extreme categories of two different, very very different categories. One is open-ended, always open for purchase or purchase and redemptions. One which is closed for purchase and redemptions during the during the closed-ended period. Now you can combine these two, and that's when you got a an interval mutual fund. That is an interval fund. Let's say, for example, I release an interval fund with a 1 year duration. So I will have an NFO period of 2 weeks, let's say. Then during that period, you can buy the units of the mutual fund. Then once the NFO period is over, the fund will become closed for further purchase and redemption, and it will be closed for 1 year. After 1 year, the fund will open for purchase and redemptions for, let's say, 2 days or 3 days, how much ever according to the SEBI rules. I think 2 to 3 days, if I remember right. It will be open for redemptions for 2 to 3 days. During that period, you can invest more money or you can take out money, whatever way you want. During those 3 days, it will act like a open-ended fund, and then for 1 year it will close and act like a closed-ended fund. Then it will open for 3 days, act like an open-ended fund, and so on and so on and so on. Now, how do you create a virtually risk-free debt mutual fund using a income fund? So, in a debt mutual fund, there are two main risks. One is the day-to-day fluctuations in the price of the bond because the yield of the bond varies, and this yield of the bond varies because of the demand and supply in the market. This can happen because of credit rating changes. This can happen because of interest rate changes, or how the market perceives the future interest rates will be, and so on. That's called interest rate risk, or it's called daily mark-to-market risk, MTM risk. This can be because of interest rate, or it can be because of credit rating or credit rating changes. The other major risk in a debt mutual fund is basically risk of default. That is basically whenever there is a big problem and you know that this company cannot pay back the debt, or when the credit rating agencies for whatever reason suddenly decide to call the downgrade the rating, and then finally when there is an actual default or delay in the interest payment, they will set it to D, and then you have the sharp drops in the NAV. Now, these are the two main risks. You can eliminate both these risks using an interval fund. So, let's say I have a 1 year interval fund that will invest only in government bonds. So, and it will hold a little bit of cash in a current account. So, a little bit of cash in a current account plus government bonds, that's the total portfolio. When I do this, credit risk basically is gone. There is no credit risk because you assume that the government will pay back money. If the government is not able to pay back its debt, like it happened in Russia, then you have much bigger problems. There will be much bigger. You won't have. You may have inflation, and you may have trouble getting hyperinflation, and you may have trouble getting food on the street. So generally, the government will assume that the government is going to pay back your debt. So your portfolio is going to be only current, just a little bit of cash, just to manage some kind of liquidity in case, and it will mostly be government bonds. Only be government bonds. Sorry, only government bonds and cash. So that takes care of the interest rate risk. That takes care of the credit risk. Now, because the fund is going to be closed for 1 year, although there will be market fluctuations, that is daily changes in prices, because because the fund is closed, and the fund manager will simply say, today I will, so the fund, once the NFO period is going to get over, the fund manager will take the money collected during the NFO period and buy 1 year gilt funds, 1 year gilt bonds, that is sovereign bonds for 1 year duration. So during that period, he's just going to hold the bond and get the interest. He's not going to try and sell it. He's not going to do he does not have any redemption pressure. He does not have to sell the bond because nobody can, in principle, practically, for all practical reasons, nobody is going to sell or buy during the closed-ended period. Therefore, that completely or more or less practically eliminates, on the safer side, if I should say, more or less eliminates interest rate risks as well. Credit risk is practically zero. Interest rate risk or daily fluctuations in bond price is eliminated, because during that period, the fund manager has got practically no pressure to buy or sell, make changes in the portfolio. And then once the fund's maturity date is nearing, we can set the maturity date accordingly. And then so the fund, once all the 1 year gilt bonds have matured, the fund manager will take the money and keep it in the current account, and then in a few days the fund will open up for sales. And when the fund opens up for sales for 2 or 3 days, the fund manager will simply be holding cash. He can handle any amount of redemptions, he can take in new money, and then once the 3 day period is over, he will again buy the 1 year government bonds again, and therefore you eliminate again, it's locked for 1 year, you eliminate interest rate risk. Of course, you can't say all types of risks are eliminated in this, because there is something called reinvestment risk. So let us say in 2020 I start in January 2020. The 1 year gilt may be trading today at 6.5%. Let's say, I don't know. I'm just saying 6.5%. That's the kind of coupon rate that you get for 1 year. In 2021, when I open again for business and buy a fresh set of 1 year bonds, the interest rate may be 6%. It can also be 7%, but it can be 6%. When I reinvest, I may be reinvesting at a lower yield. And that kind of risk will gradually be there, but that's going to happen in any kind of debt fund. So this is a very nice, simple way of practically eliminating the daily, day-to-day problems that people face in debt funds. And I don't know why why AMCs are not building this very, very simple product. So catch you later. Bye-bye.